Guys, welcome to another video from John Post Trade. In this video, I'm going to teach you guys how to mark structure, how to restructure for beginners. Stay tuned and you will learn and get valuable information from this video. Okay, welcome back guys. Welcome back. Please, if you are new to this channel, please consider subscribing. So let's go in depth to the video. So how to mark structures, restructure for beginners, guys. Now, before you proceed in your analysis for beginners, I believe you must have known about supply and demand in the market. Supply is a zone where there is much selling pressure from sellers, and demand is a zone where there is much buying pressure from the buyers. So let's proceed. When you come to the chart, you must make sure you know your higher highs and your higher lows. When market is trending downwards, you keep having a lower lows and a lower highs. That's how you know a market is trending downwards. It will be going down in a descending channel, in a descending formation. That's for you to know, okay, the trend of this market is actually going down. When the trend is going up, it goes or does opposite of the same thing. So when the market is going down, what you'll be having is series of lower highs and lower lows. Now you should be having series of lower highs and lower lows. The points that it broke before it retraces, those points are your break of structure. Like these points I'm marking out, these are your break of structures. Now you'll be having your series of lower highs and lower lows. Now in a situation whereby market is on a downtrend, you are expected that the lower high the market will not take it out. That's what you are expected. If market violates the lower high, which means you have gotten a choke in the market. So this your lower high is a protected high. You are not expecting that the market will take it out, especially when it is on a downtrend. Whenever market is on a downtrend, you are expected that the market will not take out these lower highs. These ones are protected highs. You only expected that the market will take out the lower low points. Those ones you are expected that you're expecting that the market will be taking out these lower lows. But the lower highs are the protected ones. I hope you guys are following. The lower highs are the protected ones. Now, from the previous point, from the last lower high to the last lower low before the retracement becomes your range. From that point, that place becomes your range. You are dealing with that range. You are expected that the market will start pulling back all the way to that supply zone. That place becomes your range high, a protected high. You are expected that the market will not, that's a protected liquidity. You expected the market will not take it out. If market violates and take that lower high out, what I mean by taking it out is market going above it, market structure going above it. If market structure tries and go above it, that means we are no longer on a downtrend. We are anticipating that the market will start going up. Now, before market goes to any supply or that lower high to mitigate, to test the order block, later we still teach you guys how to spot your point of interest. But for the fact that the market has started retracing and going upwards, it doesn't go directly. It will go with complex structures, little fractal structures in the market. That's how it will start to be going up. Okay, guys, I hope you guys are following. Now, that point I'm marking out is your supply. That will be your supply zone. How do you spot it out? The extreme candle, the extreme bearish candle over there, the first and the second, or the biggest extreme candle there should be your supply zone. I hope you guys are following. The candle that caused that move downwards should be your what? Supply zone. That is a point where you place your order for sell. You place your sell limit over there. When market comes up to that point, your order will be activated, and your take profit point should be that range low. I repeat, your take profit should be that range low. You aren't expected to take profit more than that place. That's where you are expected to take your profit from the market, and you are out. Before that move, market will have a little fractal movement. These ones you are seeing are fractal movement in the market, whereby market uses them to retrace to the point of interest. What do I mean by the point of interest? The place that the order is not being filled. I hope you guys are understanding and following. That's your supply zone. That point there is your supply zone. That's the point you are expecting to sell or to fill your order. Whenever market leaves a zone like this, it must come back to refill that order. That's the way the bank and the hedge funds trade. You don't leave incomplete order in the market and run away. Later market will still come back to fill that order. So that point you are seeing over there is called your supply zone. Now, immediately market starts that retracement, the retracement that market started before it reached that supply zone. That's the only time you can validate another lower low. I hope you guys are following. Immediately market started retracing. That's when you will have another what? Lower low in the market. That's when a lower low will be valid in the market. Okay. Now, in a situation like that, you now have another lower low, and market, you are expecting that market will break that the previous lower low leg that it made before it retraces. You are expecting the market will break it down and make another lower low. You are expecting the market will break that leg, causing a break of structure or a BMS, depending how you guys know what you know. But for me, I call it BMS. Some call it break of structure, depending anyone. But for the fact that you are familiar with the acronyms or the short words we use on these ones, then you are good to go. Now your range high changes from that last lower high to this recent lower high now, because that supply has been tested and it has broken another low. It has broken another external what? This external liquidity. You're expecting market to take it out. Whenever it takes it out, it becomes a BMS or a BOS. I hope you guys are following. Now, in a situation like that, you have to mark out your supply zone again, and you expect that market will start to reject and come up all the way from that downside again to the upside again. Now, from that downside where it started the retracement to the upside is your range, and you are expecting that the market will not take out this lower high. If eventually market takes out that lower high, it means that we are no more longer in a downtrend. Now we have gotten a change in the market. We have gotten a change of character, change of movement. Now the selling structure or the downtrend is no longer valid. The market has violated it, which means we are no more expecting that the market will take out that last lower low that it made. Now is protected. We're expecting the market will not take it out. Now you're expecting the market will pull back and start creating a series of higher highs and higher lows. That's what you're expecting, and you're expecting the market will come down to that point and test a demand. In a situation like this, the supply has failed. Now the demand, which are the buyers, now the buyers are in control of the market. It's no longer a seller's market now. Now it has turned to a buyer's market. In a situation like this, I hope you guys are seeing what I marked now. that range high we have been expecting the market will not take it out. Finally, it has been violated and market has taken out that range high, which simply implies that we are no longer going to be looking for a sell in the market. Rather, we are going to shift into buys. Hello guys, I hope you guys are following. You must make sure you follow the trend. Don't go against the trend. You trade what you see and not what you think. For the fact that the market has violated the structural lower high, now you are anticipating or you are expecting that the market will start what? Going for an uptrend. You are no longer expecting a downtrend movement, no matter what. You are expecting that the market will continue to be going what? Upwards. Now we are no longer on a seller's market, we are now on a buyer's market. Now you can expect this low to be your range what? Low. And the high, the one that caused that break to be your range what? High. That will be the current range you will be trading now in the market. You are no longer expecting market to take out that lower low. Now this time around, you expected that the market should stay above that lower high. Higher low. You expected the market should stay above that higher low. You expected the market should start making a series of higher highs and a higher low. You're no longer expecting the market will violate that low again. So what you're expecting is market to do a deep pullback into that your demand zone, and whenever it does that, it will mitigate the point of interest. The point of interest, the demand zone, the order that is not being filled, the market will mitigate it and it will start pushing up all the way over there to make another what? Higher high. Now, you have to spot out your demand zone. You have to spot out where is that point that market will test before I buy. Where is that point that market will test before I buy? Majority of the time is going to be the extreme, but most probably it's not going to reach there. Now that's where you must know how to identify your point of interest. Later in my next video, I may teach how to identify your point of interest, but before that, I have to teach you guys how to mark demand and supply zone. How to know your demand and supply zone. Now, in a situation like this, the market has stopped going in a descending formation. Rather, it has started moving in an ascending formation, which means we are no longer expecting markets to be selling. Rather, we are expecting market to start going all the way up. We are now in an uptrend market. Now, this place becomes your higher low, and the upper one becomes your higher high. But the first point is show the first sign that is going to break, is going to change the movement. That point becomes your what? Choke. Here becomes your what? Choke. What's the meaning of choke? Change of character. Change of character. What I mean by change of character, it has changed from the usual formation. It has changed from the usual movement. Now it's going upwards. It has reversed, thereby going upwards. After that change of character, any other break you are having in the market becomes BOS or BMS. I hope you guys are following. Now, when markets break that BMS, you haven't gotten any higher high yet until market starts pulling back. You will never consider that point a higher high. That point I mark higher high is not yet higher high until market start pulling back. But in a situation like this, you have to first mark your demand, and before that higher high will be valid, the market must start pulling back. As it has started pulling back now, that means that place becomes your higher high, and you are expecting that the market will take it out. That place becomes your what? External liquidity. You're expecting the market is going to take it out. I hope you guys are following. You're expecting the market will do what? Take it out. But that range low which means which is the higher low, you are expected the market will not tamper it. I repeat, market should not go past that what higher low. Anything that causes market to go past that higher low, which implies that we are no longer in a buyer's market, that the sellers have taken control in their market. I hope you guys are following. Please guys, consider subscribing if you are getting valuable information in this video, and I will keep updating you guys for more videos. So when market goes above that previous higher high, now we have gotten another word BMS in the market, which means we have gotten another BMS in the market. Here becomes your what? Lower high, higher low, sorry, and that point becomes your buying point. Your target should be that first or previous higher high. Don't go more than that. That should be your what? Target. You have to target your external liquidity or your previous higher high. That should be your target. As you guys can see now, we are in ascending formation. Previously we have been on a descending formation in the market, but now we are in ascending formation, and this is the current range we are dealing with. This is our range low, and above is our range what? High. This is the current range we are dealing with, and if market decides to pull back and comes down to this point and mitigate something in that range, that becomes your what? Your point of interest, and market will rally up. And remember, if market did not break that range low, there is nothing that has to do with sell. We only expecting buys, and any other thing that the market does inside, or the fact anything that the market does inside that range, for the fact that it doesn't break that higher low, you are still anticipating that the market will still go what? Up, unless it violates that higher what? Low. And so that is how the market moves. Now market will test your point of interest, and you will place your order from what? There. And your target should be your what? Higher, that high or higher high, that your previous higher high, which is your external what? Liquidity. That is a point you are expecting that the market will take it out always. If market finally completed the movement and makes another high, which means our range has shifted from that low all the way to the current one now, and you have gotten another what? BMS in the what? Market. I've gotten another BMS in the market. Now this is your current range. Now you are dealing with this current range, the one that I marked with horizontal ray. I hope you guys are following. Now you are expecting that the markets will still pull back and come to mitigate a certain area, a certain point in the market. That point it's going to come and mitigate is called your POI, or your point of interest. That point becomes your demand zone, because we are dealing with an upward movement. You're expecting market will come down. Okay guys, I hope you guys are following. In a market, in a structured market like this is a range you're expecting to see in the market. When market goes above the lower low in a downtrend market like this is the current range you are expected. That range high over there is a protected one. You are expecting that the market will not take it out. You are expecting that the market will not take it out. In a downward movement, a downtrend movement, you're expecting the market will not take out that range what? High. You're only expecting it to take out the range lows. Anything that has to do with range lows, the market should take them what? Out. But anything that has to do with that range high, it is what? Protected. If market takes it out, it means that we are no longer in a seller's market. Rather, we will be anticipating that the market will start pushing all the way up. I hope you guys are following. This is the current market. This is the current structure in the market. I hope you guys are following. This is what to expect. for market ranges. This is how it looks in the chart. But remember, the chart will not look this neat. That's why you have to know your point of interest in the market. I will teach you guys about point of interest in some of my videos coming up, but you guys have to be following up to get those valuable information, and turn off your notification bell so that whenever I post a new video, you will get notified and be the first to get the information. So now, in a situation like this, we are in a down trend. Market should not take out this high. This is a protected one. If market goes above it, we are no longer in a seller's market. We are now more of looking for buys. The same thing applicable to an uptrend. It's just opposite of exactly what you are seeing here. This is the current range you are dealing with in the market. In a downward movement, after you must have spotted your range high and your range low, you are expecting the market to start retracing. Remember, guys, when market starts its retracement, it doesn't go straight. Market doesn't have a straight movement. It goes and retraces, it goes and retraces. When it's retracing, it is filling out the imbalances in the market, filling out orders, and to continue up. You don't have only buys in the in your businesses. Maybe you are buying your goods only, you are not selling. How do you profit? So we need the sellers and the buyers. So when there is little selling, there will be little buying. That's the way the market moves. But in an uptrend, there will be more of buying than selling. That's why it is an uptrend. In a downtrend, there will be more of selling than buying. But you'll be having the two opposite parties involved in any trend in the market. You must have the both buyers and the sellers in that business in the market. You must have the both of them. But in a downtrend, there will be more of what sellers, and in an uptrend there will be more of buyers. But all of them, the buyers and sellers, will still participate before there will be a movement in the market. So get this point straight, get the facts straight in the market. So this is our downtrend movement, our downward movement. This is what we are expecting in the market. So in a situation like this, we are still expecting a downward movement. Now after that, we are expecting the market will start having a pullback all the way to the upside in order to mitigate that zone. So now market will start a complex pullback, retracement. This is a fractal market. It will start retracing until it tests that extreme supply zone. Whenever market tests that extreme supply zone, now you can expect, when it takes that extreme supply zone, you can expect that the market will start selling. But remember, it's not a must that the market will test the extreme supply zone. That's where you must make sure you have reached to the point that you can be able to dictate your point of interest, because your point of interest might not be that extreme. It will be somewhere inside that range. Inside that range we are dealing with, it will be somewhere in that range. It's not a must that it will be in that upper extreme zone. No, market can mitigate any point. All these movements you see here are are internal movement inside within a range. It's a movement within a range. It's a movement within the range high and the range low. All these ones you are seeing here are internal range movements. Anything happening there, any structure you are reading there, for the fact it didn't violate the range high and the range low, you are still on a particular range, which is in a bearish range. For the fact it didn't violate it, you are expecting that the market will drop and clear at that range low. I hope you guys are following. And getting the valuable information. Now, for the fact that market did not take that range high, did not take it out, we are still expecting that the market will drop. So in a situation like this, you mark out point of interest, you place your order and you expect that the market will drop and clear out another low. If that is completed, you now can expect that the market will start selling. If that is completed, you will expect the market to start what? Selling all the way what? Down until it creates another low. I hope you guys are following. I hope you guys are following. But if eventually market goes up above the previous range high that it created and the range low, now it means that we have gotten a violation in the market, which means we are no longer expecting ourselves in the market, rather we are expecting what? A buy. The same thing applicable to downtrend and uptrend. The same movement is the same thing. There's nothing different there. That's just how you trade price action, and that's how you trade market structure. Now in a situation like that, we have gotten a choke in the market, which means we start looking for a buy. I mean buys only. Anything that has to do with sales, you have to erase it from your mind and continue to look for buys. Don't go against the trend if you want to make money in the market. If you go against the trend, you will surely pay with your money. The market doesn't care. So now you are expecting, you have started your expectation that the market will start pushing upwards. That's the structure you're expecting to be having in the market now. Now, what are you expecting after the choke? You are expecting the market will start what? Pulling back. Whenever market takes out this external liquidity point, you are expecting that the market will pull back. Immediately it pulls back down to your point of interest. In this case is the demand zone. Now you place your order there and expect a buy. You will buy from that your demand zone, which is your point of interest, and expect that the market will make what? A new higher high. I hope you guys are following, because after this illustration, I'm just want to show you guys how it works, how it is in the market. Which after this illustration, I will still go over to the chart to show you guys how it looks in the chart. I hope you guys are following. Now we have another range. This becomes our range low and our range what? High. These points you are seeing, so you are seeing over there, has become your what? BMS. And that your BMS, that point that is your BMS is your higher what? High. And this point that is your lower range is your what? Higher low. Now we are in an uptrend movement. We are in an uptrend what? Movement. Now the structure that it used while coming down to mitigate that point of interest is your what? Fractal structure. Complex what? Pull back into that what? Range to mitigate a certain area, to mitigate a certain point in the market. Whenever it mitigates that point, now the market will start rallying all the way up to make another what? Higher high. This is exactly how you trade in the foreign exchange market. That's how price moves in every time frame, in every chart in the market, in every tradable asset. I hope you guys are following. That's how the market moves. But each and every one has their own unique movement, their own unique patterns. So we are going to go over to the chart. Let me teach you guys and show you guys the practical and live chart how the market moves. Because this one we are doing over here is illustration. I'm just showing you how it goes. But now I'm going to go over to the live chart and show you guys how it presents what? Itself. How it presents itself in the live what? Market. Okay. All right. Now we are in the live chart in the market. Let me spot out where maybe we can start marking out our structure from. As you can see, we have series of higher highs and higher lows, and series of lower lower highs and lower lows. So that's how it is in the market. So I'm trying to spot out a point whereby we can start marking out our structures, but visually when you look at the chart, you see we have the structure of the market moves on higher highs and higher lows. I hope you guys are following. All right, let's start from here. Now if you take a closer look at this chart, you will see we have uh, ascending formation in the market, which means the market is trending up in this movement. I hope you guys are seeing what I'm marking out. So we have series of what higher highs and the higher what lows. That's currently what we are having in that market over there. I hope you guys are following. Now we have this becomes our what BMS in the market. That point becomes our what BMS in the market, and after that BMS we will have a higher low. Okay, we have a range in the market, which means that place it becomes our range what low, and the above one becomes our range high, which is the current range we are dealing with. And we expect the market will pull back and test a certain area, for us to what start our buy what movement. I hope you guys are following. So that point becomes our higher high, and here becomes our what low, higher low. The range high becomes our higher high, and the range low becomes our higher what low. And you expect that the market will pull back into a demand zone, and if market pulls back to a demand zone, now we will place our order. We will start expecting that the market will rise from there. Yes, we expect the market will start rising all the way from there to the above point. If eventually it fails, which means we are no longer going to be expecting a buy, but for the fact that it holds, we are going to expect a buy, and expect that the uptrend movement should continue up. Now your TB point should be that your what higher high. When market breaks that higher high, now your range structure will change from where it is before to another point. Now you have gotten a BMS in the market, so your range structure becomes the range higher high. That becomes the higher high and the higher low. That becomes your what range structure. And in an uptrend, you are expected that the range low should not be taken, because it is a protected low in the market. You are expected that that range low should not be taken in the market. So now, as you must have identified where you are in the market, you will still have to place your buying point. As you can see, we have 2 points of interest in the market now, but we are going to buy from the first one, which if it fails, we can still buy from the second one. Later in my videos, I'll be teaching more about structure, how to spot your demand point, your point of interest. Those ones are not problem, but you have to stick around, come around, and get the valuable information. And consider subscribing, guys. So here becomes your buying point, and your target should be that the market should make another what higher high. And as you can see, market have made another higher high. Now our range have shifted from that high, from that previous high to the current one, and our higher low have shifted as well. Now we have gotten what a BMS or a BOS in the market, which is break of structure in the market. After that break of structure, we started expecting that the market will come down and mitigate a certain point, which is the demand what zone, down there. We expected that the market will come down to mitigate this zone, but I think eventually market never came over there. Market didn't came back to mitigate that zone. So we are going to leave it and follow the current structure. Now we are going to leave it. Now it becomes an unmitigated what demand zone. If eventually market comes back there in future, we may expect a reaction from the market, from that zone, because the zone is not yet what tested. But for the fact that the market failed to return to that zone, which means we have to follow the current range or the current structure that the market has presented. I hope you guys are following. Now we have our higher low there, and this point becomes our higher low again, because the market has made another what higher high. The market has made another what higher high. So that point becomes our higher low. Now here becomes our what BOS. We have a BOS over there, and our range structure has changed as well from this point, that higher low, all the way to the higher high. Now we have gotten a BMS, and in a situation like this, we are expecting to buy also in this what current structure, unless structure fails. Otherwise, as you can see in this formation, the structure failed. But before the structure must have failed, maybe you have placed your order to buy from this extreme supply zone, but eventually it failed in the market. So now that the structure has failed, sorry guys, you will expect that the market will continue what trending downwards, because you have gotten a choke, because you are expecting that the market will buy from this demand point all the way up, but eventually the market failed. So that's why you must make sure you put your risk management, your SL intact, in case things goes wrong in the market, because this is a game of probability. This is a game of probability. So now demand has failed to hold. Demand has failed to hold, which means the buyer's powers have less in the market. Now we are going to have a choke in the market, and we will start to expect more of selling pressure for the meantime, until structure goes or tells us otherwise. But as it is now, we will be expecting what a sell, only sell in the market. After the choke, we start having a series of lower highs and a lower what lows. As you can see, I'm spotting it out. Lower highs and a lower what low. These are the current structure we are dealing with after the choke in market structure. So we are expecting that the market will start a little downward movement until structure tell us otherwise, that the market is trying to go up. That's the only time, or the only hour we can expect a buy in the market, except that we are still expecting a sell. Now in a situation like this, you mark out your range highs and your range low, which are your what higher lows and your lower highs and your lower lows. That's the point you mark out. As you are seeing, as you guys are looking at the chart now, you can see me marking out the lower lows and your what lower highs. These are areas of interest. These are structure in the market. These are points we will be expecting a sell, because this is a downward movement. This is a descending formation in the market. So you only expected to be selling in a situation like this. You are only expected to be what selling in this situation, unless structure tells you what otherwise, except that you only look for sell. If you look for a buy in this market, which means you are going against the trend, and you will pay with your money. The market doesn't care. So here becomes your what range point in the market, your range highs and your range low in a downward movement. Okay, now you're expecting the market will pull back and test a certain area, a certain supply zone. Or what do I mean by the supply zone? A point that the market failed to buy, a point that the market failed to take order when it was coming down. So it's going to buy all the way to that point, and from there it will start rejecting and comes down to make another lower low. This is exactly how structure moves in the market. So in a situation like this, you spot out your supply zones, mark it out, and wait for market to come over there, and you place your order. That's basically how market moves. There is nothing much. Don't just complicate your system in the market. You don't complicate things in the market. Just keep it simple, and you enjoy this trading industry. But this is basically how the market, or the structure of the market, moves. Nothing much in it. So here becomes your range high, and the other point becomes your range low. Now this point becomes a point where you'll be expecting a sell in the market. You are expecting to sell from that point all the way until this market clear this external liquidity, and your TP should be that the market will take out the previous lower low. This is the current range you are dealing with. Now after that, you have another range. That point you mark out now becomes your supply. How do you spot your supply zone? You mark the extreme bearish candle that formed that downward movement that break the lower low. You mark it out. I believe in my next video I will still teach you guys, show you guys how to spot it out. Now you mark it out. After you must have marked it out. Now you must place your order from above there. Okay, your sell limit. From there you will sell all the way until the market takes out that external range again in the market, until market take out that liquidity in the market again. That's basically how you trade. That's basically how you do it in the market, guys. Nothing much, nothing more, nothing less. But you must know that the structure is not enough for you to make money in the market. You must know your points in the market, what makes a point to be valid. I hope you guys have followed. You must make sure you know your imbalance points in the market, what makes a point valid and invalid in the market. As you can see, we have a supply here, and our TP might have gotten hit here if we had taken this trade. Okay, now after that we are expecting that the market will still come up again to that supply, but unfortunately it failed. We have a choke over there. We have a change of market structure, a change of character over there, which means market has started moving in a bullish trend. Now we have started anticipating that the market will start moving upwards. Now the market have moved from a bearish phase to a bullish phase. Now in this situation, you are expecting to be buying in the market. Only buys, only buy, because market has failed to respect that lower highs. Rather, it has created a higher high, which means we are no longer in a seller's market. We are now going to be expecting a buy in the market. Now when are you going to buy? You will expect that the market will have a pullback. It will create a pullback to a demand zone. Where is that demand zone going to be? Which is the last lower low that the market corrected. That will be your demand zone, and you're expecting the market will pull back to that point, and immediately it pulls back to that point, you will be buying. Okay guys, this is how to read structure in the market, and thank you guys for coming around to the end of this video, and consider subscribing for me to post more videos for you guys. Thank you guys. For those who have enjoyed this video, this is GMP Trade, or you can call me John Paul's Trade. I'm going to be signing out in this video. See you guys in my next video. Shout out to you guys. Bye bye.